latest Wealthland podcast. I'm Hamza Shalchi. I'm joined today by Duncan Rayside and Elliot Parkhouse. Today's episode essentially is going to be firstly around what the majority of our UK client base is talking about and what they want to hear. And then we'll move on later to our expat audience. So there'll be a little bit of everything, including a recent survey that we just did with our clients, etc., etc. So I'll just kick straight off with a recent survey that we did. Thank you to all our clients who actually responded. Based on the survey, one of the main insights that our clients want to discuss and see more content about are investment returns, which I know Duncan's going to be dancing up and down here more to talk about, and retirement planning. So, in terms of investment returns, how are we addressing these priorities at the minute? Increasing the investment returns.
Well, we're in a bit of a sticky spot at present.
Yeah.
Due to what's been going on in America with the introduction of tariffs. Coming into the year, things were looking quite good, and most of the investment managers we speak to were quite optimistic about market return potential for 2025. As things have turned out, a massive curveball has been thrown at the markets with the tariff situation.
Okay, let's just, before you go on to the tariffs, why do you think these investment managers were so optimistic going into this year?
Well, we'd been in a period of recovery from COVID and then recovery from global inflation, and measures had been put in place to counteract inflation with higher interest rates. And we had seen that a large part of that process out over that 2-year period. And we were coming into the year with the prospect of a number of rate cuts happening, definitely in the US and probably in the UK. And rate cuts would lead to less money being held on deposit and more money flowing into the markets. So that would have naturally given quite a boost to equities. So that's the reason why we were most investment managers were somewhat optimistic about 2025.
Okay. And then what happened?
Trump came in, and no, I don't think anyone had taken him as seriously as he turned out to be about the prospect of introducing tariffs. He had mentioned them, but everyone was kind of guessing that he was going to come in and get the markets booming and make himself look good. But obviously, that's turned out not to be the case. So we've had the situation in the Oval Office with Zelensky coming in. That was a prelude to the tariff introduction a few weeks later. So the markets had a bit of a wobble about that. And then when the introduction of tariffs came around, the markets plummeted about 10 to 15% very quickly. And that's because the markets don't like uncertainty. And this tariff situation has certainly brought out a situation where there is massive uncertainty about the future and what the global marketplace is going to shape up to look like moving forward.
It was strange, that whole Oval Office, everybody surrounding Zelensky, him sitting there almost like a bully victim sitting in the middle of a...
To say it was bizarre would be an understatement.
Yeah, never seen anything like that before. So when the markets hit a 10 to 15% drop, did you, Elliot, get a lot of phone calls from your clients, worry, panic, that kind of stuff? What happens for a financial advisor?
I wouldn't say, I mean, again, speaking from personal experience, I wouldn't say I received loads of phone calls of people panicking. I think that it's certainly a period where, as a financial advisor, this is where you add the value to your clients. This is where you kind of, you kicked in and you provide the support. It's what we're ultimately paid for. So I think, there's certainly some of my client bank would reach out and, I wouldn't use the word panic, but certainly want to engage some conversations around, and quite often it's just around helping them understand, politically or invested in mutual funds, trackers, stocks, anything. All proceeds, gains, income from it is completely tax-free in the UK. The alternative...
Go on, just 1 second. Do you think when we say stocks and shares ISA, that scares people?
Yeah.
Yeah. Personally, a lot of the ISA that I come across when I'm, meeting new clients for the first time, they'll have a cash ISA. If they've got an ISA, they won't have a stocks and shares ISA.
Okay.
And I always ask the question, why? And typically the answer 9 times out of 10 is because that's what my bank, offered me.
Okay.
And if people just assume a stocks and shares ISA means they've got to go and pick their own stocks.
I think the word stocks and shares, people, stocks and shares, risk. But fundamentally, a stocks and shares ISA is identical to a pension in so many ways. You can access precisely the same types of investments in a stocks and shares ISA as you can in a pension. But pensions kind of got this kind of slow and steady type of association with it through time, whereas stocks and shares seems a bit racy.
So it
a good
does.
point.
And
It does.
It does.
It does.
And maybe they need to rename it. Maybe they need to call it an equity ISA or something along those lines because people are not utilising it.
So to that point, and not underutilisation, it's highly likely the next thing the government are going to address are what you can and can't put into ISAs. Because since interest rates have started to rise, cash ISAs have become more and more popular. And less money is flowing into stocks and shares ISAs. Money flowing into cash ISAs isn't really that great for anyone other than the people putting the money. It's not good for the wider economy.
Yeah.
Whereas money flowing into stocks and shares ISAs, then by virtue of that goes into the UK and the global markets. So it's highly likely that in the next few years that is going to be addressed. And I can see a scenario whereby your overall ISA entitlement is £20,000. It wouldn't surprise me if they limit what you can put into a cash ISA out of your £20,000 quota. Let's say 25% of your quota can only go into cash. And if you want to use the rest of it, if you want to use it, has to go into stocks and shares.
It's
Something
wild,
like
right? It's wild that something that is so good for the general public, the government wants to push. It's a bit like forcing people not to eat ultra-processed food and only eating healthy food. Like, imagine that this is actually going to be better for people in the long term to put money into a stocks and shares ISA.
It's good for the economy as well. It's particularly if the money flows into UK-linked assets.
Yeah, but it's very rare. Like, the news is filled with all these things, the extra tax that we have to pay, etc. So just to go back, do you think people actually understand that if they have a lot of cash in the bank and they're earning interest off the money in the bank, do you think that they understand that they have to pay tax on that if they're an additional rate taxpayer?
I'd say the vast majority don't understand that.
Some people do, some people don't. That's our job to gauge whether they do or they don't understand it. And then also, it's our job just to, as clearly as possible, help people understand what all these different vehicles are and why they're good for them and why they need to move their money between them. So, for example, if you've got someone who's got pension, ISA and general investment, GIA, on your platform with you, if there's no fresh cash to invest to utilise the 20 grand ISA entitlement for the year, then it just makes absolute sense in most circumstances just to move £20,000 out of the general investments into ISA. So you're just moving it into a tax efficient environment. And actually getting people to understand the logic of doing that is harder than you would expect. Just the concept of it.
I think it's much easier once they have the money on the general investment account.
Yeah, absolutely. Yeah.
I genuinely think that once you're there and you can start to blend some money across into the ISA, etc., it's the misunderstanding. It's the general public are not educated. More so, and this is something else as well, I feel as though people in the States or people from the States understand investments, stocks and shares, and they're not terrified of it. I think we might have spoken about this in the past. They're much more educated in buying single stocks, actually, stuff that they believe in, stuff that they can invest in and that'll grow over time, etc., etc. But there's a number of factors behind this. I think, first of all, they don't understand that they will pay tax on money sitting in the bank account. They don't understand that a stocks and shares ISA is actually better for them in the longer term and potentially will give them some much better returns. And the tax efficiency and access as well. I almost feel like when you say there, it's a very similar vehicle to a pension, well, people think, can't access my pension until I'm 55. Why would I do that?
Yeah.
I think just conceptualising all the different vehicles that are available
I mean,
is very important.
Yeah, it's definitely becoming. The space is definitely improving. I think you can largely thank the kind of tech disruptor banks for that. You think 10, 20 years ago, everybody just banked with RBS, NatWest, HSBC. You had your bank account. You wouldn't have had an app, but on there they'll have offered you a stocks and shares ISA maybe, or a cash ISA. That's the only real education you ever got in the UK around those vehicles. Whereas now, at least, you've got Monzo and Revolut, all these relevant institutions who are definitely making, financial education a little bit easier. My exposure to the US is they're miles ahead of us, from even just the if you have a bank account, you're with Charles Schwab or whatever, you're going to have a representative provided by the bank who's going to be contacting you, with setting up investment accounts, setting up trading accounts. You don't get that. You don't get that in the UK. But I do feel we're going to certainly the introduction of these digitalized banks is definitely helping, because these products are becoming more available to people.
Yeah. So we got to digital banks, a lot more information on digital banks.
Yeah.
I've signed up to a couple of digital banks and use a few through business banking and through personal banking as well. I still don't think they do a great job of educating people on ISAs and stuff like that. One of them that I do see is
savings accounts, maybe.
Savings accounts.
They are definitely hitting that.
My God, they hit the savings accounts. But my savings account just said to me, for the next 6 months, I can get 4.5% interest if I open another savings account. So what do you do? My nan will say to me, oh, I want that extra 1.5 or 1.8% interest that I can get on that savings account. Great. A lot of people still don't understand that they'll pay tax on the interest earned in that savings account if they're higher rate or additional rate taxpayers. Madness. So what more can be done, and where does it need to be done to actually educate clients on this? Because I'll be honest with you, some clients that I come across, bigger clients, more money in the bank, whatever, if I mention to them ISA, they look at me as if to say, that's a bit boring, that's a bit dull.
Yeah, because the natural association for many people is ISA, cash ISA. It's
almost insulting to them.
Yeah.
And yet it's the simple... What's insulting to me is that they don't have one and they've got that much money.
Yeah, which is ridiculous.
The simple wins, absolute bread and butter. Everybody who's got some savings should have an ISA, shouldn't they?
Yeah. Oh, absolutely. And there's no there's no negative aspect to having one.
As long as you're a UK resident.
Yeah.
Any of our US connected clients definitely should not have an ISA, but
should not have a stocks and shares ISA.
They're not sexy, are they? ISAs, there's nothing. Nobody sits in a pub and talks about an ISA or a pension, do they?
I think that. Well, no, probably for good reason. But there are hardly any tax breaks available to the general public at all. Pension is one that most people are pretty much aware of and get the benefits, because obviously you get the tax relief on the way in, etc., and tax-free growth. I think other than ISA, there are a few others, but ISA is the next main one, and it is underutilised. And it's a £20,000 per year tax wrapper, £40,000 for a couple. That soon builds up over. If you had a 10-year period, that would build up to a significant chunk of cash for your retirement funding in addition to your pension.
What about junior ISAs? Does anybody have clients that use junior ISAs or understand them or not?
I mean, personally, got one for my son. I've got clients that have got them.
He'll be dipping into that soon, won't he?
No, my son's got them as well. They love seeing the investment returns, and they know.
Really?
Have you told them?
I haven't been.
Yeah, they've got it linked to their Go Henry cards.
Right.
Wow.
Yeah.
Okay. I haven't been that transparent. I have had some conversations around the type of ETFs and trackers that we've used, but I'm too scared of him wanting the amount when he's 18 and saying thank you very much.
Now, is that the problem with a junior ISA? That if a child wants to access, well, they're not a child at 18, But if an 18-year-old, essentially still a teenager, wants to access their junior ISA, there's no limits on it, is there?
There's no limitations. I mean, in about 14 months' time, I'll know exactly what can be done, what the legalities are. But as far as I'm aware, it's you have no control of the parent other than contributions up until 18, and then it legally.
I think that just comes down to the parenting, doesn't it?
So, rewind to 18-year-old Duncan Rayside. You get £50,000 given to you. What are you doing with it?
I'd have been having a really good time.
There's a problem there with the junior ISA, isn't there?
There is, but again, only speaking from experience, what I would do with 50,000 at 18 and what my son would do with 50,000 are actually two very different things.
Yeah.
I think kids, maybe off topic, but are definitely more sensible.
I think in most circumstances, in all circumstances, the parents are involved in setting up the junior ISA and overseeing it and have visibility. So
it's only natural that you've engaged in conversations around the investment, which depends. I've definitely not gone like
and you would
detail
imagine
of its weekly performance, but you're going to have conversations around what we're going to do with it.
Yeah, exactly. It would have been there for many years building up, and you would be having constant conversations about what that money is there for them in the future. So they, you're probably going to get the odd one who's going to cash it in and go and have a really good time.
Yeah, but for like we were talking about before about financial education, it's a powerful tool. They've been able to. I mean, I personally found it a very powerful tool, being able to engage in conversations, not necessarily about investments, but like having conversations around, my son's thinking of going to university. He's 2.5 years away from that. But, what does university cost? How are we going to fund that? And I'm like, well, this is the reason why we've been using something like a junior ISA. It's not so you can go to Thailand for 8 weeks traveling and buy a car. It's so that, we can do X, Y, Z. So
buy a car in Thailand or?
I think sports cars are quite expensive in Asia, aren't they? Tuk-tuk, yeah.
So there's two tax efficient tools.
Lifetime ISA as well.
Lifetime ISAs. Talk to me about them, because again, it's not something that I have many clients that
they're
have
there
utilised.
to be used if you're not a homeowner yet.
Okay.
Yeah. So
I
it's
think
an additional ISA entitlement on top of your standard that you can utilise if you're not a homeowner.
And the government puts some contributions towards that, don't they?
Yeah.
Okay. Touching a bit more on the tax topic. Recently, the new Chancellor announced that pensions will form part of your estate on death. How has that affected you and your clients? And first of all, what do you think of the decision?
It didn't really come as much of a surprise. Pensions are always an obvious target if there's taxes that need to come into the system sooner, so it didn't really come much of a surprise. But it does certainly affect the financial planning process. A lot of people made decisions off the back of the old rules and now faced with the new rules, and they just have to deal with them. So moving forward, in terms of your planning, adjustments will be made. It may lead to, in the past, pensions were, it was advisable in most cases to defer tapping into your pension until you had maybe accessed other resources that were exposed to inheritance tax. That's not going to be the case any longer. Having said that, the pension still does retain the tax-free growth wrapper around it, which is hugely beneficial with the compound growth that goes on within the pension, even though the pension will be tapped into for inheritance tax upon death of the person or the second spouse, etc. So, in summary, it just requires some analysis and some detailed and decent financial planning to help the individual understand how things are going to work, what the tax situation is going to look like, and help them make the right decision for their own assets, which ones to start drawing upon at what stage in life.
A lot of business owners that I know it's effectively cost them millions, unless of course they die before 2027. It's been I think a massive change to our financial planning. And you're right, it almost now makes me think, well, should people, there's still the advantages, obviously, the immediate tax advantages, But on the flip side, somebody that's got the 40% tax relief on their pension on the way in is effectively still going to pay, if they have a large estate, 40% on their way out.
Yep.
On death. Or if they draw it all down, they're going to pay 20%. Let's say if they're a basic rate taxpayer in retirement, they're going to pay 20% on the drawdown, or again, it could be much higher depending on how much they take out of their pension. Then you've got that double dip again of another 40% inheritance tax on that as well.
Yep.
It's definitely a sneaky move. And
I was surprised. I know you said it doesn't shock you. I was very, very surprised at that. I mean, I was thinking they were going to reduce the amount you could actually contribute to a pension.
Yeah, but I mean, we spent so much on during COVID on furloughs and things like that. The country needed to recoup what had gone out, so it was no surprise that pensions were targeted, in my view, anyway.
sounds like we've got a Labour supporter sat next to us.
It does.
No,
It sounds. I also think that there's thousands of them out there, millions, I guess, and billions could be reclaimed on companies that claimed furlough, and people were still working. They essentially claimed it, and now we were promised that would be reclaimed. It just leaves me with a little bit of a bitter taste in my mouth for my clients who have built businesses, sold them, put pension money aside to pass on the next generation. I just feel like it's a very, very, to some people, it might sound like a huge amount, the £1 million inheritance tax threshold, once we take in the residence nil rate band as well. But it doesn't sound like a lot to me for somebody that's owned a business for 20 or 30 years, that's maybe employed hundreds of people, given them the opportunity, paid national insurance contributions for them, has paid corporation tax, has paid income tax, all of those other things, and then probably paid a large capital gains tax sum as well when they sold their business, to then be hit with huge taxes on inheritance through...
Yeah.
I had one client actually tell me £2 million it's going to cost him.
Yeah, no doubt. The other thing there, in terms of on allowances as well, most of the allowances that are available to people remain frozen. So whether that be your tax-free allowance on your income, that remained frozen for quite some time.
Basic rate taxpayer?
Basic rate taxpayer.
Was it 2018 that was introduced at 50 and then and it's frozen till 2028?
Yeah.
So 2018 that was introduced and it stays until 2028, and in that 10-year period, inflation it'll probably have run on average at 4 to 4.5%. Yeah. Is that fair? Well, let's say it's 5%.
Well, let's
Cost of living has definitely increased by 50, 60%.
Right.
You know.
There we go. In that time period.
And the other one is probably more significant than that is nil rate band on inheritance tax. Been at £325,000 per person for, well, it's like 20 years, isn't it?
I don't know. We'll need to look at that.
Yeah, it's a
long
time.
It's a long time.
It hasn't moved for 2 decades, I believe. And what have house prices done in those 2 decades? The main asset that's driving up estates is real estate, right?
Yeah.
House prices, where they are now, where they were 20 years ago.
Down south, they've doubled.
Yeah.
Not
so
moved in
effectively, it's a massive stealth tax that no one even really talks about, that the nil rate bands haven't kept track with inflation.
So nil rate band has stayed at 325 for close to 20 years,
I believe
you think,
so.
right? Long time.
Yeah, long time.
And then house prices have probably doubled in that time, easily.
Yeah.
There's nothing that can be done with, let's say, your only asset is your house.
Yeah.
If you bought a £325,000 house as a single man on your own, that house then becomes £650,000.
Yeah.
Single man on his own. What are you going to do with the rest of that money? It's 40% tax on that, isn't it?
Yeah.
Now when was residence nil rate ban introduced?
I don't know when it was introduced, to be honest, off the top of my head, but that comes into play as well if the majority of the estate is
in the property.
In the property, yeah. And obviously it's lost if the estate, it's in 2009, was it? Yeah. And then obviously if the overall estate is worth in 2 million, then you lose that, don't you?
Yeah.
Yeah. So there are, well, this kind of so all of these tax reliefs that you get on that type, on inheritance tax and all that kind of thing, you can counter them with utilising the tax benefit reliefs that you get with your pension allowances and your ISA allowances. And that is what I feel a lot of people aren't really cottoning on to. You can offset them to a degree.
What? But you can't offset that inheritance tax, really,
You
can
can't
you?
offset the inheritance tax.
Unless you start doing complex tax and trust planning.
Yeah, true.
Which then becomes very complex, which, again, I mean, we're talking about probably half of our clients when we first meet them don't actually fully understand tax relief on pensions and ISAs.
Yeah.
And then once you start going to somebody who's maybe got, and it won't be unheard of in your postcodes to have people with £1 million houses, they've got £1 million houses plus pensions. If their estate then creeps over the 2 million, there's straight away this 40% tax, which is, as you said, probably forms part of that stealth tax. I never really thought of it as a stealth tax.
Yeah, the thing that it potentially is going to come into play more and more so moving forward is using life insurance products to counter the tax, placing a whole of life policy or even a term assurance policy into a discretionary trust put in place to pay the inheritance tax bill when it arises. And that's something that, particularly for younger people who, if they sit down with a financial planner and try and kind of work out what they may very well be worth in the future, is something that's well worth doing and sitting down and understanding earlier in life than perhaps you would maybe generally think about considering these things.
I see where you're going. So you think that if somebody sits down with a financial planner now,
Yep.
works out what their wealth would be worth in the future,
Yeah.
so let's say you sit down with somebody who's 40 years old, could get a lot more life cover for a much cheaper cost.
Correct.
Yeah.
Yeah.
They set up a life cover now because their wealth might be worth X amount in the future.
So
to
typically,
offset it.
A lot of people get towards reaching their kind of earning potential career-wise by their mid-40s, right? We know a lot of people that are doing very well by their mid-40s. They've maybe started their family, they've bought their forever home, they're making their pension contributions, etc., etc. So at that stage in life, you're still relatively cheap to insure, like for life insurance, much cheaper than you would be 10 years or 20 years later. So, sitting down with a financial planner and doing some cash flow management and some forecasting as to what you might be net worth later on, and having that discussion about, do you want to protect your assets from tax, obviously many years down the line, hopefully. If so, is it of value to maybe do some planning around that at this stage in life when you're earning well, you've got a clear roadmap for what you're going to be worth in the future because you've got a good financial plan in place? It's probably a sensible conversation to have, I would say.
And it's a very logical conversation because, again, I feel as though life insurance is something that is very, very under-advised on.
Yeah, sure.
And over this last couple of weeks, I've realised the importance with a client having life insurance and being diagnosed with a terminal illness.
Yeah.
And life insurance companies will actually, if somebody is diagnosed with a terminal illness, will actually pay out prior to their death, which can be very, very helpful for spouses, for continuing with costs and stuff like that. So that being a point, there's another added benefit to life insurance that people don't talk about and have never really thought about, that a lot of people would have their life insurance mature at retirement. Whereas if it's a life insurance which is a whole of life insurance,
Perhaps, yeah.
or one that carries on further into retirement, essentially will not only cover the death if it were to happen when you've got all the outgoings and you haven't built that wealth, but it would also cover the inheritance tax after that as well.
That's right. And if you're healthy, don't smoke, etc., your life expectancy is probably going to be mid-80s from an actuarial perspective. And let's say you wanted to protect your pension in case you died sooner than life expectancy, at your life expectant age.
Yeah.
You could have, let's say, a financial plan to protect the inheritance tax on the pension through your 70s. And you could even have a term assurance policy, which would be a lot cheaper than a whole of life, with a financial plan to maybe withdraw and gift away some of that money out of the pension over that period of time. Where you get to the point, let's say, when you're 80, where you've brought the value of your pension down through gifting and spending it down to a level that is not much of a tax problem should you die and then inheritance tax kicks in, just as an example. So there's lots of ways in which you could approach it.
And life insurance is actually, for somebody in their late 30s, early 40s, it's very, very cheap, really. I think I went down as £1 million cover cost about £80 a month.
Yeah, the earlier you take it, the cheaper it is.
Yeah.
Simple as that.
It's not a lot of money at all, really, is it? People pay spend more than that on Sky.
Yeah,
a lot more than that.
Most people will also look at it from, just getting the mortgage paid off, as an example, and maybe a bit extra. But it's worth having a broader conversation on other things you might want to get yourself covered for, and just evaluate the cost benefit of doing so.
Yeah, no, I think it's definitely something that that is overlooked, and it's such a simple solution to the IHD problems that people might now be facing with pensions.
And just to clarify that point, for it to be set up for that purpose, you would establish it and hold the life insurance policy, assign it to a discretionary trust, so it falls outside of the estate and is not that asset that is paid out in the form of the life insurance payout does not form part of the inheritance taxable estate.
Okay. There's also benefits of putting that life insurance in trust as well for, what's the word I'm looking for? There's benefits of putting your life insurance in trust so that it doesn't go through probate, so it will actually pay out much quicker.
Yeah.
And that is something that, again, until you're faced with the scenario of death, people don't actually understand why they should put their life insurance into trust. The easiest, quickest way is it doesn't go through probate if it's in trust.
And it becomes accessible to the beneficiaries who might have other assets to deal with that take a long time to get sorted out, but inheritance tax is due on those assets and the wider estate sooner than they can access some cash, and then they run into liquidity problems, and then expensive bridging loans come into play, and all this kind of stuff. So there's lots of virtues to considering this as part of your financial plan.
Brilliant. On the subject of death, there's a segment here on general questions on intergenerational wealth transfer. Who wants to talk about that topic?
I think that topic is really talking about from a financial planner's perspective. It's really important for us as financial planners to not only get to know our clients, obviously, but get to know the important people in their lives who are going to benefit from their assets in the long term, and hopefully, build up a relationship with those people. So when the time comes, they know who they're dealing with and they know who to speak to. And perhaps the options that are available to them have been explained to them ahead of, tragic events like their parent passing away.
Yeah, it's. I think a lot of those things, when these things actually happen, and you live them out, I think one of the comforts, if you knew that you only had a certain amount of time left to live, and all the things that you needed to tick, all the boxes, make sure that everything was left behind in the way that you would want it to be. I think knowing that there is somebody that you've worked with for 10, 15, 20 years, or even somebody that you'd worked with for a year, that they understood your family circumstances, that your kids will be looked after, that they're not going to go and spend it all, that they're going to be protected maybe from...
And also understand, Elliot, don't you think, understanding the strategies that can be deployed to pass those assets, like, for example, beneficiary pensions and things like that, that's something we've covered a lot in the last couple of years, isn't it?
Yeah, exactly. I mean, obviously it differs whether you're dealing with an expat client and a UK client, but even on the back of the fun and joy around the budget announcement and the inclusion of pensions in IHT, certainly from my perspective, it's open conversations that I hadn't had before. I might have dealt with the husband or the wife primarily, and dealt with some detailed financial planning. Part of it was based around their UK pension, but now clearly there needs to be a plan within that family that will, upon first death, the survivor needs to understand that actually, the £1 million they might have in a UK pension is going to be fully taxed, part of the estate upon second death. So sensible plan to be spending it, and potentially drawing down on it sooner than you might have thought. So those type of conversations, I'll be honest, weren't as frequent pre the pension rule changes.
So just delve on them a little bit more. Build on the whole beneficiary pensions, benefits, all of that. Let's use an example. A client, married couple. He has £1 million in his pension, dies at the age of 73. What happens with his pension, with his SIP?
Well, depends on where he's resident, depends on his beneficiaries, depends on the provider. In a perfect world, easiest solution is his beneficiary is a UK resident, he's a UK resident. And the pension provider offers a beneficiary SIP, okay. And then the person named down as a beneficiary in that pension inherits the pension, basically. The exact same rules and, SIP benefits are passed on.
Other than the fact there's no age limitation on the beneficiary SIP in terms of
Correct.
access.
Correct. So they could be
say they're a
15-year-old.
15-year-old or 15-year-old grandchild or a 45-year-old daughter.
Yeah. They inherit that pension, and then in reality they've then got tax deferred pot to draw on.
The scenario is different depending upon the age of the deceased.
Okay.
So pre-75, if it's passed to beneficiaries, there's no income tax due on the pension.
Yeah.
So the beneficiary will put inheritance tax to the side for one.
Yeah.
Right? So then the beneficiary could have the option to take it all as tax-free cash, liquidate the assets, or they could have it moved to a beneficiary drawdown account. So it depends upon the circumstances of the person inheriting the money. Let's say there might be two siblings. One needs some cash at that time in their life. The other doesn't. The other is well set financially. Because if you take it as cash, you're moving it out into a taxable environment. Whereas if you move it to a beneficiary pension, you are retaining it in a very tax efficient environment. Maybe you don't need that money for another 20 years. Let it grow and roll up tax free. Okay. If the person dies after the age of 75, the beneficiaries will have to pay income tax on what they draw. If they cashed it in, it would be fully income taxable, the full amount. If they moved it to a beneficiary pension, they're in control of when they pay their income tax. They will have to pay income tax on it. But let's say the scenario that I painted out there, where one of the beneficiaries, one of the siblings, is a high income, higher rate tax payer. They're not necessarily going to want to have to add that chunk of cash onto their income tax bill for the year. So the utilisation of a beneficiary drawdown account is a perfect vehicle for someone in that scenario.
So let's say the deceased dies after 75, two children, both working, neither of them need let's say neither
one
of them
could do with a cash injection and one couldn't. That's
okay.
Quite a good scenario.
So the one that needs the cash injection is going to pay at their marginal rate of income tax anything that they take from it. The one that doesn't need it can set it aside for their future. They'll pay no tax now, just when they draw it down. And
bear in mind, let's say in that scenario, one of the beneficiaries is a basic rate taxpayer, but then they get their share of a £200,000 pension payout. Suddenly there's £100,000 of taxable income going on to taking them up to more than likely nudging additional rate tax for that particular year, and then that would cause them potentially a problem the following tax year to equalise their tax position, and so all of these things need to be taken into account.
So how often? There's so many cases of me meeting somebody who's maybe worked as an expat for 20 or 30 years, coming back to the UK, retiring, and then mentioning, oh, I did have a pension 2 years ago, 3 years ago, 10 years ago, 30 years ago, whatever, that I paid a little bit into, and then they come across this pension, they find it, and it might be worth 100 or 200,000 pounds. They don't know about. Is that a scenario you come across a lot?
Very frequent.
Right.
Yeah.
How up to date, especially right when and it's maybe a little stereotypical, but how often do you think somebody that works offshore on the oil rigs ends up being divorced? Now, just go with me on this. They end up divorced. Yeah?
Yeah.
Right. This pension that they thought was £10,000 back in the day.
Yeah.
Yeah. In 1995.
Yeah.
How important do you think it will be to them, thinking that it's not worth much at all, to change the beneficiary on that pension? Because the beneficiary on the pension is likely to still be the ex-spouse.
Yeah.
And I don't think people actually change the beneficiaries on their pension because they don't realise what actually happens with their pensions when they die.
Yeah.
So the importance of actually checking all of these pensions, not just to make sure you've got enough for retirement,
but
ensuring that
you've got the right people lined up to benefit from your...
Anything happens to you,
I reckon 50% of my clients have been divorced. It happens, doesn't it? What is it? One in 3 people that gets married ends up getting divorced at some point in their lives?
Yeah, that's a good point.
Yeah, it's a big stat. It's a big stat.
So people need to check their pensions and make sure that their ex-wives or ex-husbands are not the beneficiaries of their pensions.
Yeah.
Definitely. And, you know, that's obviously an example of an offshore individual who's in the UK. We come across and deal with a lot of expat clients living overseas. A lot of clients living in the US who, again, it's so important they do exactly the same thing. Most people make an assumption that their UK pension provider will give them exactly what they want when they retire, even if they're living overseas, and they'll give them exactly what they want when they die. Why would they think otherwise? A lot of people just aren't aware that, you know, a lot of the typical UK schemes that have been consolidated, bought by insurers, Phoenix Life, Aviva, Aegon, all these big well-known names, you know, I mean, fundamentally, number one, a lot of them cannot offer flexible access drawdown to an overseas resident. So when somebody is of retirement age wanting the simplicity of accessing their pension, can they take, you know, they might have a pot of 500,000, can they take £20,000 a year out, you know, some flexible income, it's called flexible access drawdown. They can't.
They can't offer the flexi access drawdown, right? Not necessarily just to expats, but some can't offer the flexi access drawdown. Then some pension companies don't deal with people overseas. Most pension companies don't deal with people that are overseas. Yeah. So there's no flexi access drawdown. I'm not dealing with somebody that's overseas. What else?
As we spoke about before, beneficiary pensions and the ability for a beneficiary drawdown account to be enabled. You know, you might have your wife and son as the beneficiary in your pension, living in the US, been there 20 years. Your pension provider, you don't know it yet because you haven't accessed it, but can't offer you flexible access drawdown and might not be able to offer beneficiary pension to your beneficiaries. Well, what does that mean? Well, upon your death, you would make an assumption that everything's fine. They're going to inherit the money. They can't take the scenario of a super flexible beneficiary pension drawdown account where they can access the money to suit their taxable income needs. They are forced to take a taxable payout, taxed at source in the UK at a lump sum payout rate of 55%. You know, when in reality that could all be fully avoided just by making sure that the pension was with the right provider that was going to offer them all the benefits they wanted while they were alive, and that would offer a beneficiary pension to their beneficiaries. It's simple, but I would say 90% of the client meetings we have, they're not aware of that.
That scenario happens all the time, and that scenario is categorically never covered in any literature or brochure that you'll get from your pension provider.
But it doesn't matter even if it was, it would be 10 pages down in the terms and conditions. We've just been talking before about people not understanding what an ISA is. How are they going to know what a beneficiary pension is, or how people are actually going to be taxed on this hard-earned money?
Yeah.
Might not be hard-earned, by the way. People get pensions for doing nothing sometimes, but you know what I mean. Like, it's money that is theirs that is essentially not going to be... If you asked 10 people into a room and said, who would you rather your money went to, HMRC or your children? What's the answer going to be?
Yeah, true.
It's super simple, basic stuff, but to your point, it's not educated and it's overlooked.
And on the point of what we just discussed about beneficiary pensions, about overseas workers or overseas, let's say expats that are retired overseas, we're a financial planning firm regulated in this country directly by the FCA, and we have staff that call these pension companies every single day to get updates on what our clients' pensions are doing. And we can't get a hold of anybody on the phone.
Yeah, they don't make it easy. Not to mention if you're unfortunately, an overseas resident at one of these fantastic institutions and you've got a non-UK address, they can just shut the door. And then, a lot of the time we're instructed by a client, we want to get into some detailed financial planning and some cross-border planning. But first of all, we actually need to find out what we've got in these pensions. I've got a statement. I've had one last week, got a statement from 12 years ago, got a statement from 8 years ago. When we last had an address, they won't send us anything now. And, you assume there'd be 20, small amounts of money, but you uncover 500,000, 600,000 pots of cash at these insurance companies who are typically charging 1%, They're not giving any advice. They're not even communicating about all the problems they're going to potentially uncover when they, want to access it, or heaven forbid something happens to them. So it's kind of basics 101. That's everyone overseas needs to have a look at that.
Do you think, sorry to interrupt, Duncan, but do you think a pension company should have an obligation to tell the beneficiary of a pension, so essentially if it was my pension provider, has an obligation to tell me how much I will be taxed or my family will be taxed when I'm gone if I don't sort this out?
Maybe not the beneficiary, but that it should be something that is openly communicated. How can the government make all these changes in the UK with the new budget and how things are going to be taxed, and there's actually nothing that gets through to the person it affects the most? If you're in the UK and you watch the news and you read what's publicised, you'll get a wind of it, or you've got a financial advisor, of course, but the majority of people haven't, and they're just none the wiser.
I think one thing to try to make clear to everyone is that the first port of call for anyone establishing an understanding of what their entitlements are for their pension is the paperwork that their pension provider sends out to them. And one thing to make clear is that all companies, without question, only have one set of paperwork aimed at a global audience, and that paperwork is written with a UK resident in mind. And one thing that I think providers should do on their paperwork is make it very clear that if you are not a UK resident and you have a policy with us, please be aware that some, if not most of the information in this brochure may not actually be relevant to you, and we very much advise you to touch base with a cross-border pension specialist to help you understand what parts of the information are relevant to you and what parts of the information are not relevant and not available to you.
Okay. Let's go back on, because we've exhausted pensions, I think, and I was talking about not sexy subjects. I mean, nobody's going to tune in to listen to hours of pensions, but when we go back to that intergenerational money being passed down, how often is it that you meet with a client's children?
From time to time. Sometimes they're involved in the... At this very moment in time, I'm dealing with a person who has a pension, sorry, back on pensions now, and his daughter is helping him sort it out. So I'm doing a lot of the communication through her to get it sorted out for him. But I would say more often than not, we don't speak to the wider family.
By 2027, wealth transfers are going to go from the current levels of £69 billion up to 115 billion pound, what a number, 115 billion pound every single year. Why do we think the reasons of the increase are so vast?
Basically because of demographics, where the baby boomers are now going into their 70s and 80s, and that's the reason. And then they're reaching life expectancy in their early to mid 80s.
And as we spoke about earlier, the bulk of those assets that they own are probably going to have been property that they've held in the years where property's at its biggest boom.
They're the generations had the lovely final salary pensions and bought their properties in the 70s and 80s and 90s. And
bought the ex-council house for 500 quid. It's now worth 500 grand, and they're going to be passing on a lot of wealth. Okay, great. So do we think it's, well, obviously with all of this being passed on, is it important that we as financial advisors do have meetings with their children and essentially talk to them about what happens with the funds once it's inherited?
It's definitely a conversation that needs to take place more. And again, speaking from personal experience, one of the outcomes of the inclusion of pensions, in everybody's inheritance tax now, is personally I have, been approached to have conversations with beneficiaries and families at quite a high level, but still, want you to meet my wife, want you to meet my children. I think it's definitely taken the complexity of financial planning up a gear. Like you said, it's always been a case of really focusing on cash flow modeling, making sure that we truly understand, how long all the money's going to last and what tax you're going to pay. But now having conversations around, well, how can we, cover any potential inheritance tax bill through, insurance and life cover. And I think part of that now needs to be around, making sure that the family as a wider whole know that, right, here's Elliot, whoever the financial advisor is, here's your contact, here's where our will's kept, here's a will provider, just that real kind of family planning. Conversations definitely weren't happening before, but I think there's a huge space for it being a regular thing.
And why do you think those conversations don't happen? Because I had this conversation last week with a client and who said to me, my father's got loads of money. He's got it here, there and everywhere, and I reckon his estate is worth X amount. But every time I broach the conversation, he doesn't want to have that conversation with him. Why is it, you think, that generation, which is, in their 70s and 80s now, doesn't want to have a conversation with their children about their inheritance?
Because they're faced with their own mortality and they want to...
Must be a trend. I'm exactly the same. I've lost count of the amount of people are saying, I wish you could have a chat with my parents or my father. They're in their 80s, they've got X, Y, Z. And it's almost, I'm like, well, let's have the conversation. I know we've, especially in the last couple of years, we've probably had our interactions over Teams or Zoom, but I'm always, well, let me, let's come up to the family house and I'll meet them. And does seem to be a reluctancy for that conversation.
Where is that reluctance? Because I spoke to somebody today about the reluctance of men talking to a financial advisor. Because, and we spoke about this before, the whole egotistical thing of getting help with your finances. And especially with, I don't know if it's an age thing, whether someone, a 70-year-old with lots of money wants to have a conversation with somebody half their age about what they should be doing with their money. Mm-hmm. What do you think is the reason that they don't want to have a conversation with you? Or is it a financial advisor they don't want to have a conversation with? Or is it their kids they don't want to have a conversation with?
I think more and more so these days, there's a lot of scams out there, right? And there's older generations are being targeted with all of the scams, whether it's text message scamming, email scamming, etc. So there is a general trepidation when it comes to your money and your assets in dealing with someone that you don't actually have any kind of initial familiarity with.
Yeah.
If that person does come as an introduction via the son or the daughter, great. That's a relatively strong standing point. But even still,
it still doesn't happen, though, does it?
No.
Has anyone? I'm like, my mind's thinking right now. I can't count how many times it's come to a point of a conversation if you should have a chat with my parents or my mother or father. But
it never
to this
happens.
point, it's never happened.
No, even one of my good mates from back home, he has said to me, the amount of times he said to me, you need to have a chat with my mum. You need to have a chat with my mum about X, Y, and Z. And I see her around and I think to myself, she knows what I do. Does she want to have that conversation? Is it something I should instigate? Is it something that maybe they're insecure to talk to me about? Like, they know who I am. And I've got one of these things that, especially with people I know, I'd never ever go and tell people, pitch my services. People know what I do. They'll come to us and talk to me. And yeah, it very, very rarely happens.
You need time to do it. So you can put provisions in place to cover yourself for tax bills, etc. But ultimately, a lot of it comes down to, having a gifting plan, for example. And gifting takes time. There's limits to what you can gift. There's time periods that you need to live for beyond the gift to make it tax-free, ultimately. So that dictates that you need to have a plan years in advance, and people often just leave it too late.
Yeah, I mean, maybe it's the whole broaching the subject of mortality.
Yeah.
Possibly they don't want their children to get their hands on the money earlier. I doubt it, but it does seem to be...
I mean, surely people don't think that the majority of people must have faith that in their kids not to want to get their hands on their inheritance. Surely. It blows my mind, this conversation, this subject that hardly anybody wants to talk to a financial advisor about. It's a guarantee. People go and talk to accountants all the time about death. Why don't they talk to a financial advisor about death?
There's, going back to earlier in our conversation, a lot of the wealth is tied up in the value of real estate. Sometimes, people are very reluctant to leave that home if they've lived in it for years. Perhaps they don't need the big 4 or 5 bedroom house anymore, but the concept of selling that to release some of the capital to be able to gift away is something that they don't want to entertain. But if you do that, then that potentially can create you more benefits as well. If you give the money away, there's less money to be means checked if you need to go into a home and need care, etc. But these are all quite sensitive conversations to have, and if there's no familiarity with you about the individual you're having that sensitive conversation with, I think that's where the main problem lies.
Yeah, and the problem is, no matter what the solution, they all require taking some pretty swift action. If you're having a conversation with somebody in their 70s, well, you've kind of got to get a move on to put these plans in place. And if that's something that's been ignored for the last 40 years since they've recognised they've had wealth, that's, from a psychological point of view, clearly there's a barrier.
Yeah.
But I mean, from a firm perspective, we're definitely doing our bit of engaging these conversations and making sure that inheritance tax planning and trust planning is all part of everyday conversation. And
but when you do start these processes, there's that psychological aspect to it that say this is that person's beginning of their process of dying, which they don't want to kind of contemplate.
It is definitely the trickier part of
I wonder if it's I wonder if it's maybe if we painted this picture as opposed to talking about death. Do we need to paint a bit of a nicer picture about it and paint it as a legacy? What do you want to leave behind as something that you created, that you built, that you passed on to the next generation? Maybe talking about mortality and death isn't a nice subject to have, but maybe talking about a legacy or something that you've created, that you've actually done. It's almost like a charity to your children, isn't it?
Yeah, I mean, if I'm pretty sure if there was something that was released by the government called a death ISA, I don't hold me to that name, but something that was like,
you could only pay into on Halloween, yeah.
But something that you put money in and it was free of inheritance tax and it would go to your kids. Like,
well,
I think
that's a good idea. Actually,
let's face it, the government are not going to step in and create nice new ways for you to pass your wealth tax efficiently.
Of course they're not.
Because they want the money.
You say that, but we said before that there might be a bit more encouragement, and obviously it's good for the markets, but a bit more encouragement to put money into a stocks and shares ISA as opposed to a cash ISA. Yeah. Maybe it's something that does need to be done. Death ISAs, let's put that to them.
But to your point though, if the outcome and the benefit of that not being a conversation, not being something that's heavily marketed from a product perspective, is the government just sweeps up 40% of everything that's not spoken about. Is it ever going to get changed?
I think if we can paint it as a legacy as opposed to death, if we can paint it as something that is passed on no matter what, if we can get people to check all of their beneficiaries on their pensions, if we can get them to dig out all the information that isn't left behind for these huge insurance companies, if we can get them to almost think about when they're not here, what could they leave behind? It appeals to me. It's such a sexy subject to go, this is what I could leave behind for my family, and then they could leave behind to their generations. We love the thought of carrying on the family names. Well, build the family legacy and keep as much in the legacy and as little from the legacy going to HMRC.
Oh yeah, there's no doubt from a planning perspective, there's loads of quick wins that you can do with the family. Like you say, the basics of looking at beneficiaries. But I guess we probably got lost a little bit on what the government might or might not do about it. Definitely lots that we can do.
I mean, it's complex. This could be another 2 hours worth of chat right here. So some of let's move on to expats. Obviously, one of the areas that the majority, or not the majority, but has more British expats than anywhere else is obviously the US for many reasons. We talked about the markets and the big companies that are headquartered over in the US. What are some of the top financial challenges that you're seeing for British expats when dealing with assets that they have in both the UK and the US?
Which question was this? Was this question 7?
Well, the first question, very early in the conversation, tax comes up. Okay, people are worried about their tax position on the assets that they draw income from the UK if they live in America. They're very unclear on where they stand from an income tax perspective, and then the conversation, with inheritance tax, the estate planning perspective as well. So that's an area that we have good solutions for and good partnerships in place to assist our clients with.
Okay.
Yeah, so I mean, there's two sides of that, I guess. Is you've got tax on current investments, income while you're alive and while you're paying tax potentially in either country, and then you've also got the considerations around tax upon death. If you've got assets in either country, there is a dual taxation agreement between the US and the UK. It's been around for a very long time, but that doesn't stop doesn't stop the US thinking they have taxing rights on a certain asset because it's in the US and vice versa. So super important that, if you're an expat living overseas, if you're somebody with assets in either country, you're getting the right tax advice to really, really understand how things are going to be taxed today, right now, from a tax return perspective, and then more importantly, upon death.
Yeah. And to Elliot's point on tax, thankfully the situation has become a bit simpler now with inheritance tax moving to a residency status rather than a domicile, moving away from domicile. So that simply means that from an inheritance tax perspective, if you live in America and have UK assets, it's only the UK situs assets that would be inheritance taxable. So let's say you've got some property in the UK, you've got a pension in the UK. Those types of assets will be potentially subject to UK inheritance tax. Whereas before, your domicile, it was linked to domicile, and that would have meant that perhaps your non-UK assets might have been subject to inheritance tax. From an income tax perspective, if you live in America and draw income from a UK pension, as an example, the US have ultimate taxing rights on that income. However, in most circumstances, unless you do something about it, the UK will withdraw tax at source. So you're in a situation where you could be double taxed.
How do you mitigate that?
So a solution for that is simply, virtually every US-based person that we've come into contact with should acquire themselves what's called an NT code from the UK tax office. That's a no tax code. And by virtue of the tax treaty between the two countries, you just need to demonstrate via some HMRC and some IRS forms being completed and sent on ultimately to HMRC to demonstrate that you are a US tax resident and you would like an NT code, that NT code can then be put onto the PAYE payroll for your pension provider in the UK. If you've got a state pension as well, call the Department of Pensions in the UK to get that NT code applied to your state pension payments as well.
Do they answer the phone?
They don't, and I, from experience, wouldn't recommend anybody to tackle that themselves. There are lots of firms out there, we can recommend them, who for a super reasonable amount of money, a couple of $100, can actually manage that process from start to finish.
And you can give them authority to speak to the Department of Work and Pensions on your behalf.
And once it's set up, it's also set up for life, which is a bit of a misconception. A lot of information online thinking it needs to be done every tax year. That's irrelevant. Once you've got an NT tax code, it's set up. I'm right in saying you can only set it up once you're of pensionable age from a private pension.
Yeah.
As part of the process, you actually have to get set up on payroll with that pension provider, and you have to take some form of benefit.
Yeah, and don't fall into the trap of expecting if you've got multiple pensions paying you out, don't fall into the trap of expecting it automatically to be applied to each one. You need to make sure each one has the NT code applied. It doesn't happen automatically.
Have you seen a lot more clients leaving the US now, or wanting to leave the US with the recent Trump election? I know there was a lot of noise about a lot of them moving from the US. There's EU visa programs now being launched. Have we seen a pattern of this?
Definitely an uptick in US citizens wanting to move overseas. Whether, thinking more broadly, whether that's in a response to Mr. Trump, who I know everybody's not a cup of tea, but like you said, also we've had a huge surge of these kind of nomad and retirement-based visas around the EU, with favourable tax regimes and pretty relatively easy visa programs. We've definitely seen an increase, and again, for all the cross-border planning detail we got into around British expats living overseas, the same things apply to US citizens and US connected individuals, probably more so because where, in the UK, we've had some changes with the new residency rule over domicility. As a US citizen, you're taxed globally on your worldwide earnings as you're alive as well upon death, which clearly there needs to be factored in if you're going to go and live overseas. You are still going to have to report and potentially pay taxes in the US every year, which obviously adds some complications. So, I guess it's a given that whatever investments, income, anything you might have in the US before repatriating or moving needs to be looked at. You're going to need to understand how that's going to be taxed in your new country, and more importantly, from a cross-border planning perspective, is there something that can be done? Is there some action you need to take? Do you need some specific tax advice? Something we get involved with day to day sounds super basic, but if I've got, say, which most Americans do, if I've got an investment portfolio, brokerage account, or I've got an individual retirement account, maybe one of the big providers like Charles Schwab or Edward Jones, can the institution that's currently holding my money, can they actually look after me? Am I still going to be able to make investment changes? Am I still going to be able to access the funds? Will they let me have an overseas address on file? The answer 9 times out of 10 is no. Unless you're a US resident, most institutions can't look after you. So again, that's where cross-border planning really, really comes to the forefront, that we can make sure, have a look at their current investments, have a look at the current savings they've got, and make sure they're with the right providers, because there are some really simple solutions 9 times out of 10 just changing to a cross-border friendly provider. Typically the typical kind of investments they might have had for a long time can remain, and it just means that you can go and live in Spain, take benefit of an overseas visa program, and get full access, full financial planning support that maybe you had in the US, you can get when you're in the EU.
Because there's still Americans moving to the UK. There's a lot of Americans obviously living in the UK. There's a lot of former British expats that have spent a large part of their career in the US that have these retirement accounts that are now living in the UK and retiring in the UK. A lot of them still have their reporting obligations for their US taxes. Obviously, we have relationships with accountants that we can refer them to. But a lot of the institutions in America, you're saying, they don't want to deal, a bit like UK pension providers don't want to deal with people that don't have a UK address. A lot of US providers also don't want to deal with non-US residents.
Correct. There are some out there that do. But, especially, our average client will have a brokerage account with, a share portfolio. They'll have a retirement account. They'll have a Roth IRA. They'll typically have multiple assets with one provider. And they're the typical providers that don't offer a cross-border service.
Okay.
Which means, if you're a 40-year-old professional moving to London, because you've got a job with one of the big banks, well, your typical saving strategy in the US might have been contributing to your workplace pension equivalent, your 401k. It might have been making contributions every year to your brokerage account. They're things that you're not going to be able to do when you're on UK soil. So, again, there are alternatives out there where they can continue that strategy, but make use of UK products as well.
And with, again, Americans that retire in the UK, what happens with their social security? Their social security payments?
Pretty much most circumstances, as long as you have enough qualifying years and you are entitled to a social security, that social security income can be paid anywhere, doesn't matter where you live.
Okay. We do have cases of former British expats moving back to the UK and drawing down on social security and UK state pensions along with other pensions as well, don't we?
We do. There's some detail and nuance around that. It depends on the complexity of whether they hold a US citizenship. There are a lot of, we come across a lot of professionals who have been in the US, maybe working for 15 years, have built up sizable private investments in the US, as well as then have probably a quite sizable social security entitlement. If they renounce their US citizenship or their green card or whatever right they had to be in the US and come back to the UK, technically on paper, by the letter of the law, that social security benefit should end. But I'm personally not aware of any clients where it has. Once in payment, it always seems to continue. But from a planning perspective, certainly these cross-border cases, we will always plan around that benefit. If you're not a US citizen, I think that's the key piece here. If you're a US citizen, you're entitled to that social security wherever you are, regardless. The complexity around that lies if you're a British citizen who's been in the US for a period of time and accumulated that benefit, what then happens with it when you leave?
But again, tax relationships accountants that we have, cross-border accountants that can help these clients clear up what kind of income they pay, what jurisdiction they pay it in, and help them plan towards their demise, yeah?
That's it. I mean, most US citizens, certainly the type of individuals approach us from a cross-border perspective, have a 401k or an individual retirement account that they'll have built up the majority of their retirement provisions in. There's some really simple cross-border planning advice that can be given there. If that individual wants to leave the US and go and live in the EU or anywhere outside of the US, when it comes to taking income and taking benefit from that retirement account, there would be an automatic 30% withholding tax deducted, basically by the US, which obviously, could be fully equalised and sorted through a tax return. But again, it's an extra thing to think about. Whereas by just simply potentially changing provider, if you're going to be an expat living overseas, drawing income from these benefits living overseas, simply moving to a cross-border friendly retirement account or 401k provider, which a cross-border advisor can help with, would mean that there's no withholding tax. So that payment could be paid out gross. You could be living in London, taking 50 grand a year from your retirement account and ultimately just paying tax in the UK where you live.
Okay, off subject slightly. Some of our clients in our recent survey noted issues of using UK platforms as non-residents. Have you found issues with UK platforms for non-residents, and how have you tackled these?
Yeah, I mean, for our US client, for example, you have the issue of PFIC taxation. So PFIC stands for Passive Foreign Investment Companies, a fancy way of describing a mutual fund which is not registered in the US. Effectively, the US expect all mutual funds around the world who have units held by US connected people to report back to them what investments those US connected people have in their fund.
Yeah.
That's quite a costly process for a fund to report back to the US on, and effectively the US don't like you holding those assets in non-US registered funds, so they tax you quite heavily on holding those investments. So that is why investment platforms outside of the US are reluctant to have US connected people as clients.
But there are platforms out there that will look after US connected people on general investment accounts that will have US qualifying investments that they can use.
Correct. There are, but they only tend to be accessible via a qualified advisor. They're not direct to consumer types of investment platform.
Okay. And for non-US connected individuals who are going overseas, they've heard all horror stories about transferring their pensions or getting expat advisors to look after their pensions.
Yeah.
What would you give them as a bit of advice or a solution? If you're moving overseas for a few years to do some work, you want to continue to have a financial advisor help you with managing your assets while you're overseas, what would your advice be then?
Arguably no different than if they were, a UK resident, in that 9 times out of 10 it makes sense just to, lift up the bonnet, as they say, and have a look at underneath at what your pension consists of, what it's invested in, how it operates, the benefits it will give you. 9 times out of 10, that probably isn't the best, most low-cost solution for a UK resident. Somebody wanting to go and live overseas, even more of a reason to look at it. Like we mentioned, heaven forbid something happened to them, well, it's quite possible that pension won't offer a beneficiary pension. Might be if they haven't got a UK address or they're overseas, they won't be able to make any investment changes. It's definitely something that somebody should look at. I think another piece we mentioned before around general investment accounts and holding assets overseas, we've been approached a lot around this recently of, don't know the driving forces, but wealthy individuals in the US wanting to relocate, wanting to move their assets out of the US. They might be US dollar held investments. They might not necessarily want to have that currency exchange hit of moving it to pounds, moving it to dollars. I think a lot of people are very unaware that there are solutions for you to be able to still hold US dollar investments outside of the US, and that doesn't necessarily just have to be held in, an individual retirement account. It could be that someone has a share portfolio that they've held on a New York listed brokerage, and they want repatriated outside of the US, maybe because they don't think very highly of Donald Trump and what might be brought there. They might want to move to London and also not want that money to be held in pounds in the UK from a tax perspective. They might want it to be held overseas. There are lots of solutions there, whether it be Jersey or overseas. And again, it's just all part of that wider cross-border planning solution.
Last one before we go, I'll ask each of you this question. One key piece of advice you would give a British expat managing wealth across the borders in 2025. British expat, cross-border, best bit of advice, Duncan?
I would recommend that they have a good think about, if they are going to appoint a financial advisor, where that advisor is regulated and what products that advisor could give them access to. So we firmly believe, let's say if we're on the subject of pensions, your pension is a UK regulated financial product. We feel it is most beneficial to the client for the advice that they take on that UK regulated product to come from an advisor who is regulated under the same regulator as the product. Simple as that.
Cool. Elliot?
My one bit of advice would be, honestly, just to sit down with a cross-border advisor and go through the motions once of having a look at all your assets and your investments. And
A Headway one, yeah?
Obviously a Headway Wealth advisor. My name's Elliot Parkhouse, handle above me. And having a look at your investments, as all the reasons we've spoken about.
Do you know what? I think just with recent events, I think that I honestly think that everybody should look at their assets and just make sure. I was blown away that I was speaking to somebody who has a file, an actual physical folder in his office with his wife's name on it and it has all the instructions. If he dropped dead tomorrow, it has everything mapped out to know exactly where everything is, and has all his boxes ticked. His life insurance, his pension beneficiaries are done, where his ISAs are, how much is in there, where she should get this information, that information, to the absolute penny, who owes him money. He's got 3 different businesses, how she can get money from here and here and here. And I feel as though everybody should take this year to just tick all the boxes and make sure that if you're not here tomorrow, what are you leaving behind and what does it look like?
Don't disagree with that.
Don't disagree with that. Very nice.
How about you, Duncan?
What's the question?
2025.
Financial habit.
One
financial habit that someone can build in 2025.
just build the habit, if you do have investments, of not panicking and making rash decisions based upon the noise around you.
I'd like to take this opportunity to thank my mother for raising me. No. Well, that's all we've got time for, unfortunately. Thank you very much, Elliot. Thank you, Duncan, for making the 15-minute trip into London. I'd like to thank Michelle and Maisie for setting this up, and let's do this again soon.
Definitely.
Sounds good.
Thanks.